President Trump is set to sign a successor to the free trade agreement that will make modest changes to the deal he once called a disaster, easing uncertainty for companies reliant on tariff-free commerce. Now, the Canadian dollar hit a 4-month high on news of the tentative agreement, and the Mexican peso is also trading higher. We're now joined by our guests, Janet Henry, Global Chief Economist at HSBC, and John Normand, the Head of Cross-Asset Fundamental Strategy at JPMorgan. So thank you both for joining us. John, how big a deal is this? It seems that I don't know whether the read across is that actually we're going to see more exemptions like this, or that it's the U.S. softening, or this is just good news for these, three blocks.
I think it's a big deal for this week for North American markets. I don't think it's a big deal globally when you think about all the trade issues that are in play, particularly the ones between U.S. and China. So, as you mentioned earlier, these are modest changes in the agreements. It's not a transformational type agreement, and therefore I don't think anyone's going to be upgrading their views on growth, trade balances, all the sort of big macro indicators as a result of this. It will make people more comfortable owning Canada and Mexico because there was some risk premium in those markets for the disruption of Nafta, but I don't think this is a big issue in terms of read across to U.S. and China.
Janet, I guess this, again, is better than no deal if they were to rip something up. Does it impact U.S. growth?
Probably not. U.S. growth at the moment in the near term still looks pretty solid. Consumer confidence at an 18-year high, post-tax profits certainly very high. And I think, short term, it is good for sentiment. It's not so long ago that we didn't, we thought things would stretch on into 2019. It still looks very like the original Nafta deal. But even Canada and Mexico are not exempt from the steel and aluminium tariffs. They may have quotas to protect them from the auto tariffs should they come through next year. So, no, I don't think it has a material impact beyond, as John says, this short-term sentiment.
Well, to both of you, let me start with Janet. Janet, to me, it's a massive amount of saving face, but what's really interesting to me about it are the TPP elements. Both Secretary Clinton and President Trump said we're not doing TPP, but we got some Trans-Pacific Partnership elements into this document today, didn't we?
I must admit, given that it only came out at 2 minutes to midnight, I haven't checked every line of it,
Right,
Tom.
that's fair. Okay.
But I think, as we touched on, there's still some broader issues to do with trade, and a lot of those will extend to the US-China trading relationship, and still this possible disruption to supply chains that may come through. But I think also looking at it, from a European perspective as well as an Asian one, the big way in which the concerns about trade is impacting is on investment sentiment. There can be little doubt that, yes, world trade growth had already slowed. A lot of that's to do with some slowdown in investment spending outside the US, and this concern about how much trade tensions can deteriorate is still been weighing on investor sentiment. So that's where I think we are starting to see some of the macro impact feed through globally.
John Normand, are loonie and peso tradable this morning?
Absolutely, because I think that getting some continuity in terms of policy, trade policy between the U.S. and Canada means you just don't really have obstacles to the Bank of Canada hiking rates over the next year alongside the Fed. And because that can happen in the context of a very high oil price, I think the Canadian dollar continues to appreciate. Now, peso, of course, turned a few months ago when we had the results of the Mexican presidential elections in July. So I don't think there's as much scope for the peso to outperform, but I do think it's going to be taken higher on the back of today's news.